So many investments have declined in value as a result of the economic downturn, and that's led some angry investors to bring cases before the courts. For viewers who've suffered losses, Andrew, could you explain a little bit about what that process involves?
Yeah, I mean, no one likes to lose money, and generally when someone does lose money, they're looking for someone to blame, but it doesn't necessarily follow that because someone has lost, that someone else is responsible for that. So what's really required is a forensic analysis of the nature of the investment that they entered into. For example, the suitability of the scheme for the individual investor.
And can you give some examples of what might be unsuitable investments?
Yeah, I mean, there's an obligation on the part of people offering investments to make sure the investment is suitable for each individual, and that should be properly recorded at the time the investment is offered and made. I mean, an unsuitable example would be if, for example, you had an old age pensioner with €1 million of assets and they were asked to invest 750,000 in a 10-year high-risk investment scheme, because clearly the length of time doesn't suit the person, the amount involved is a very high proportion of their total income, and the risk involved is probably not suitable for them either. So that would be a highly unsuitable investment.
And apart from unsuitable investments, you mentioned that there are other areas that a forensic analysis would also look at.
Yeah, I mean, one of the key areas is really what the investment offering was and whether that was actually matched with the reality. Very often you see situations where the level of due diligence which was done at the outset in terms of the offering was perhaps not fully as good as it could have been. Particularly, I think, where you have examples during the Celtic Tiger years where investment advisors were very keen to get as many investments as possible, and also there was probably a feeling that there was very little risk attached to many investments, whereas the reality of what's actually happened is that a lot of those investments have become highly risky.
And in terms of investors accepting risk, is there an education process there for investors, or is that looked at in any way in the course of a forensic analysis?
Well, I think it's the old saying, caveat emptor, you know, let buyer beware, does apply, and people have some responsibility themselves. And I think that's one of the issues that arises in some of these cases, that the investor has to accept that they took some risk on board themselves. So, for example, if someone has invested in a property deal and the property has gone down in value, they must accept some of the responsibility that they took on the market risk there. Where the risk isn't taken on by the investor, though, for example, it wasn't properly explained to them, or where the investment actually turned out to be something different than they thought it was, that's where the risk probably hasn't been taken on by the investor, and where they therefore probably have a claim.
Okay, and those would be some of the factors that typically would have caused loss outside?
Yeah, I mean, an example might be that I thought I was putting my money into a safe investment in a property scheme based in Ireland, and then the money has actually ended up being invested in another country, Bulgaria or somewhere more exotic, and the loss has arisen because the money was invested in a less safe jurisdiction.